I'll just give an overview. I think there's hopefully some good clarity on our three strategic pillars, which are in the appendice there around owning the performance technology stack, obviously leveraging the halo we have there into the prosumer market, and then pillar 3 being data commercialisation. And we've been executing on those three pillars. And at the AGM in November, I put out these 5 priorities for FY18. So I just wanted to give a little bit of an update on how we're travelling there and double-click on a couple of them, and particularly off the back of some of the feedback that we've had over the last couple of days with the results being out there. Grow Elite is obviously a key priority for us as a business across that stack. It was really pleasing to see Elite revenue up 34% year on year, about 138 new teams signed up in that half. And the subscription base up 42% year on year to just under 16,000 units. And I might click a bit on the churn later on, which we've included for the first time, and you'll continue to see us provide more granularity and data and transparency around our metrics as the halves go on. Just under 2,800 subs units sold, and once again, low penetration. We've spoken about this at the full year with the total addressable market of 10,000 teams. We've got low penetration of 15 to 16%. We're really focused on pushing that harder. And the customer economics are really strong. The LTV to CAC ratio of 7 gives us great faith that we should continue to invest in this space. Priority 2 there around league-wide deals and data. I was pleased. I always like to see more league-wide deals come through, but we landed 2 for the half. One for the RFL, which was a really good one for us from a competitive perspective, given we took out Stat Sports in their home market in the UK there, and off the back of some of the work we did with the State of Origin and data commercialisation, where the RFL were really excited by that, and there's the potential to do a commercial deal with them in that space in the year ahead. AFLW 2 with the progression of elite women's sport here in Australia and beyond. It was terrific to leverage that off the existing relationship we have with the AFL here. It was a good one to land, and there are a number in the pipeline. And as I've said before, the frustration is probably just the time it takes, the different governance models that are in place there. But it will continue to be a focus for us in the right markets. Data commercialisation. We had a hypothesis a year ago that we could take live in-game data and potentially generate engagement with fans via broadcast and shoulder programming and app usage, and we did that 4 times throughout the year, which was great to see. State of Origin, the AFL, end of the AFL home and away series and final series, the NBL for the full season, and also Cricket Australia, the last test in Sydney here, and also in the one day in the T20 series. So some good examples of proving out that hypothesis, but still, the revenues, to be candid, are pretty immaterial. But we've learnt a lot in that last year, and we're doing some more thinking work around what role we've got to play there and how we can monetize that beyond financial year 18. The prosumer launch, a lot of progress in the background over the last 6 months there with the product enhancements. I'll also further on in the slide deck just go through a little more information we've provided around the addressable market there, as we did for Elite. On track for Q4 launch and some good momentum on the sales side, which I'll touch on later. Investment in growth. 1, 2 and 3 are growth, but from a product perspective, we acquired the AMS from the Athlete Management System from SportsMed Plus in August. We've integrated that over the last 6 months. Really pleased with the work that's gone in there, that's been driven by Anton on our side, and 11 new sales came through, and we expect to see more growth, and that's one of the components of that performance technology stack, and we have that now. And then tactical analytics with video and with wearables. We have this ability to create tactical analytics by taking the wearables and video data and putting it together to provide deeper, meaningful insights for tactical coaches. And we spun up that team in that half, and really pleased with the progress they're making there, and I might touch on that a little bit later on. Also, some measured investment in our sales force. Now that we've got far more belief in that addressable market and the customer economics, we put on some more sales and some marketing folk over that half. Organisational excellence, I've touched on Mark. Mark Hall, our new CFO, Marcus Zima. We brought an in-house counsel in for the first time, and we'll continue to build out that team with the capability that we need, but really importantly, develop the got there, and building out that bench strength is going to be really important for us to achieve the aggressive growth agenda that we've got. I might just move quickly through onto slide 7, just on the elite subscription base, and just giving you a view there of where we ended for the half. But importantly, for the first time, we're providing some real granular information around churn. And I think if you just turn to slide 34, you can see there that we're really breaking that out, and we'll do this every half from now on to ensure that we're providing that level of visibility. Churn of units from teams we lost for the half was 582. Importantly, 28% of that, or about 155, came from one client, which was US Soccer. So that's an abnormal number in one hit to lose, given sort of the biggest rosters tend to be the NFL teams of about 80-odd. So that was the real churn number. The second point there is around teams reducing the number of units, and that is, we've got an existing relationship, but they may have returned 5 or 10 units if they've removed a pathways team, or they originally ordered. So they're still customers, but that is in our numbers. And also high school switching to player tech. So a small number probably weren't on the right product to start with, who have gone down to our player tech offering. So just important point there is we've got a grasp on that. We'll provide that level of granularity ongoing, and it's a real move away from, I think in the past we described churn as logo churn, which was losing 18 as opposed to units based on the teams that we have. So the number there is sort of just under 5% on the team basis for the half. It gives us that level of granularity. We can understand more, combined with some of the MPS work we're doing and customer research we're doing. So if we do have an issue with retention, we know it, and we can step on it quickly, while at the same time focusing on new growth initiatives. Flipping onto slide 8, just on Elite Video, we had a few questions around the performance there. Look, it really met our expectations. We expect single-digit growth year on year. Obviously, we're being impacted by some of the currency or the strength of the US dollar at the moment. So on that slide there on page 8, we've put the US dollar comparison in there. So the core coaching solutions component actually grew for the year, which was a good result, or for the half. And then we lost a deal on content licensing with Fox Sports, so that can bounce around a little bit. And also a couple of renewals that didn't come through in that half, which we expect to come through in the second half. But the real growth for us, and obviously the strategic importance of Exos and that acquisition in terms of having that key video offering in the performance technology stack, is really important. But the real growth comes from internationalisation of that offering and taking that to global markets, which we'll do in the first half of FY19 off the back of the investment that we're making in tactical analytics. And that's also the second phase in the second half of FY19, where we'll start to take products to market that I described earlier. Just moving on quickly, I mean, slide 9 is an important one for us, just in terms of, the 1,638 clients we now have across wearables and video and AMS, 35 sports and 61 countries, and going into some new geographies, with a greater understanding of that addressable market, much more faith in terms of where we deploy our resources and what our expectations are. So really pleased to see some really good wins come through in new markets, and also in some of the bigger sports, particularly around soccer, with the MLS in the US and the Bundesliga in Germany. Over half of those teams now are using our product, and that's a really good sign for us that we're getting momentum in some of those countries and leagues. I'll move on to slide 11 now, just in terms of prosumer. I think that's an important slide that we're sharing with you, just around that large addressable market that we have there. We're going after soccer. It is the global sport. I hate saying that as a big AFL supporter, but that's the reality. And there's 3 million, identified elite aspirants that we're going after initially, and then a market of 20 million that we're really going to press hard to launch and go into. Flipping between sort of slide 11 and 12, we were really pleased with the growth that we saw in the second half, over 5,300 units of player tech sold. And importantly, we've given you a bit of visibility there around geography and the sports that we've been selling into, which really reinforces our belief that soccer is where we should go first. And at the same time, Benoit and the team in London and Dundalk in Ireland are doing a really good job building out the new product in terms of the device and the pod and the charging station. The whole kit, the packaging, the garment is all on track for a soft launch at the end of Q4. Moving through onto just slide 15, just in terms of tactical analytics, just trying to once again just give you a bit of a teaser of what's coming there and our investment in tactical analytics. If you can remember, when I started back in May, we raised some capital to buy AMS, but also to either build or buy tactical analytics, and we decided to build. And building tactical analytics gives us internationalisation of the video offering, so we can take it from just being a North American product into all geographies and sports, but also obviously the second phase of that, and you see some examples there with some of the advanced tactical search and some of the data visualization products we've already got up as MVTs, that they're going to be really important for us to start to take to market and test and learn. Progress there by the team. We're doing that in a measured way and allocating our resources the right way for the future growth of really delivering on pillar one of owning that performance technology stack. I might leave it there in terms of slides for me, and I'll hand over to Mark Hall to run us through the financial overview. Then I'll come back and answer questions. Thank you.
Thank you, Joe. Good afternoon. I will start on page 20, just to run through the summary financial performance for the half. What we have done here is we have normalised for a like-for-like basis. Last year we bought the Elite Video business Exos in August, 12th of August. So what we've done here is produce some pro forma numbers that adds back that's 6 weeks. So it's a 6-month like-for-like. And I've circled there, first of all, our revenue growth was reported at 30%, underlying 14%, underpinned by 34% growth in our Elite Wearable business. And as Joe mentioned, our Elite Video business was virtually flat, half on half on a constant currency basis for the reasons that Joe outlined. Halfway down the page, I've highlighted the employment expenses up 39% on a like-for-like basis. I'll run through in a few moments the makeup of that. We did invest heavily in our sales capability and customer support, going after that significant LTV to CAC opportunity and untapped market. So we have made some conscious investments in the back half of FY17 into the first half of FY18 that underpins that employment expense. And we're also investing in new product, which we have broken out in the segment note for the first time. The third red circle there you'll see is underlying EBITDA. So underlying EBITDA was negative for the half at 3.9 million. That's against a 1.6 million gain in the corresponding half last period. And I'll step through what underpins that, particularly the investments we have made, as I mentioned. And down the bottom, we outline the ARR, which you'll see at a group level grew off the back of a very strong increase in ARR for our Elite Wearable. And the Elite Video was slightly negative for the reasons that Joe also outlined. That was in line with expectations, and we expect that to pick up in the second half to achieve the annual growth rates that Joe alluded to of single digit. Moving to page 21, we just run through the revenue by product. What we've done here is on a pro forma constant currency basis, so you can see like for like. Once again, highlights the strong growth in our Elite Wearable, shows that our core products in the Elite Video space grew, and then obviously the impact of FX, and also importantly a new revenue stream being the prosumer segment grew 1.3 million for the year. So that, albeit a small base, is quite a pleasing result. Moving to slide 22, which gives you a waterfall of the movement in EBITDA, moving from the left being the FY17 first half across to the right being the FY18 first half. The key area to draw out is in the middle there, where we have been very transparent about the investments we have made. 2.3 million in sales and marketing, 0.9 million in customer support, which in our world is basically sports scientists and people building out these stadiums with our Clear Sky predominant component of that 0.9. So that is a conscious effort to actually chase that market opportunity I mentioned. And then lastly, the investment we've made in our prosumer product and tactical analytics, and we've drawn that out to give you full transparency of what we are investing in those new revenue streams. Moving to slide 23, just on cash flow. Our cash position improved from June from 16.7 up to 18.2. So a positive net cash outcome off the back of very strong receipts from our customers. We did receive a government grant of 1.9, but offsetting that, we did move to a new office in Melbourne, which did virtually offset that 1.9 million. We have 18.2 in the bank at the half. We have 9.7 million in accounts receivable, and we have access to a facility of a further 2.8 million that we can draw down in this second half. Moving to page 24, here I outline the segment results. Up the top on the left, I point out that our core segments are deriving positive EBITDA, albeit the investments we have made. We outline the new products, as I mentioned, and corporate costs. It shows here it's declining. Once I pull out one-offs, our corporate costs are stabilising. They have been growing over recent years, but now we're working on stabilising those costs and getting leverage from our corporate centre. The following page, just quickly touch on our investment in R&D, which is important for a SaaS business like ours. So we are continuing to invest around 10% of our revenues in R&D, which was around 3.4 for the half. And then just on the last page, just to confirm our guidance for the full year at between 76 and 81 million dollars revenue, positive underlying EBITDA. I should have mentioned earlier on that 90% of our EBITDA loss for the first half was in the first quarter. That trajectory changed significantly in quarter two, and that is what's underpinning our positive full year underlying EBITDA. And also, just on the right, we've demonstrated there that in the last 4 years, about 60% of our revenue is in H2. So whilst it might seem on face value a big uplift, that is the seasonality of our business.
And just to round off, just the last slide there for me, just to go through in terms of looking ahead. It has been a transformational 12 months for the organisation, both through some of the organic growth and the M&A. It's been no mean feat doing that. And I guess a really important part for us now is to make sure that we execute on those sorts of activities that have happened. We fundamentally believe we've strengthened our global position and presence, and we are uniquely placed compared to our competitors to really take advantage of the opportunities in the elite markets and the prosumer markets. And we have obviously a greater sense of granularity and detail around that with the work that's been done over the last 6 months. Those addressable markets, obviously we need to make sure that we prioritise, and I think execution and prioritisation are becoming two key words across the business. We've laid a number of those bets, and we're absolutely focused on delivering there. The strategy for us hasn't changed. We've got those 3 pillars. We've got clarity across the organisation there. And importantly, we're getting, I think, much smarter around how we deploy the resources that we've got, which is for me, phase 2 and 3 of what we've been doing through the acquisitions and some of the organic growth. And Mark has already started to drive that level of activity across the business too. So that's just the summary there. We think we're absolutely focused on the right long-term priorities here, and if we execute effectively on those, we will generate significant shareholder returns over the medium to long term.